Hi there, this is Chris from MoneyHub, and this video looks at how to use an amortization calculator. So this is very popular with anyone borrowing or who has a mortgage. And what we're going to do is go through how it all works and show a real life example. So without further ado, let's just get straight into it. What we're going to do is we're going to look at a $500,000 mortgage, and we're going to look at a term of 25 years, which is a standard home loan term. We're going to drop the interest rate from 10%, which is a bit scary, down to something more sort of conservative. Let's go 7. And then we're going to do a start date as well. I'm recording this in July 2023, so we'll do that right there. Now, what does this show? This shows that the interest rate is at 7, and over the course of 25 years, the amount of interest that you'll be charged for the $500,000 mortgage is going to be $560,169, and you'll make a monthly repayment to your bank or to your lender of $3,534. Now, of course, we know, and this is always the case, that interest rates move up and down. So this is just looking at a whole loan, assuming that you didn't touch it for 25 years. You just make the payments, and then it gets renewed, and everything carries on. Of course, we know people may get a lump sum somewhere, drop this down once they renew after 3 years, after 5 years, whenever the term expires. So we know that, but we just want to go through and show you what this looks like. So this graph looks complicated, but I can assure you it's not. And let me just walk through exactly what it all means. So let's ignore 2023. And what you can see here in 2024 is a whole bunch of bars, and then this thing, so this line trailing down, or start to trail down. What this shows you is it's showing you a whole year of interest and principal payments, and then it's showing you the balance of your loan. So because we've gone and paid some the previous year, that $500,000 is now down to $489 and $3, and you can see that in this year, the total money that you've paid around $42,000 of mortgage repayments. It's going to be $34,000 or so of interest payments as part of that, and then $7,800 of principal. And what happens over time is, because you're starting to pay off the principal, but at the same time the loan amount is quite high, so you're being charged lots of interest, then it's going to slowly decrease the amount of interest that you're charged in cash terms, and that's going to be matched by increases in the amount of principal. So over time, this is some 15 or sort of 12, 15, 20 years on, as you can see that more and more of your mortgage payments go towards principal and less of them go towards interest. And then finally, that 25 years later, or whenever you do pay it off, you will see that in the final year, $24,000 went to principal and $567 went to interest. Now, you don't actually see that when you are paying your mortgage every month. You're just seeing a fixed amount. You're seeing, say, $3,534 come out of your bank account, but that's how it's going to work. And if I just show you the monthly amortization, which is much more interesting than looking at the annual. Well, I find that anyway. And you can see per month, it's slowly going down, the amount of interest in cash terms, and the principal's slowly going up. And you can see also the balance of the loan that starts to drop and it's all being driven by the amount of principal. So your loan balance obviously won't drop if you pay $1 of principal and the rest of interest, because you're just paying interest. It's not actually bringing down the balance. So over time, and it's really interesting to go through this, well, certainly I find it interesting, you can see that the principal is going up and up and up, and you'll eventually reach an inflection point where the principal is higher than the interest. And we can see it's going to be about, in this loan, certainly it's about 12, sort of 13 years into it. And then you can see that slowly as well, the principal being repaid, which is this column here, is going to almost be double what the interest is. But still, it's going to be $3,534 per month, assuming nothing changes on the interest rate, etc., etc. And then eventually, those principal payments are just such a high percentage of the monthly mortgage payment that it just drops and drops and drops, and that's when you pay off your mortgage. So that's why it's often very hard for people to understand exactly what's going on, because all they see is this amount, and of course over 2021, 22, 23, and assumingly some years in the future, we see these mortgage rates moving around, and it just confuses people. So really, I think the best starting point is looking at an amortization calculator and going through it and just seeing, how it's all going to work. And then if you do think, okay, well, I did inherit some money or something's happened, next time we refinance, because say it's on a 2-year, 3-year term, then you may find that you've already paid back, say say this amount after 3 years. If we change it to the yearly, say after 3 years, we're left with a 461, because of course you've made lots of principal payments per year and you also paid a whole bunch of interest. Then, it's like, okay, well, we've got that, but we've also got, some $30,000, which someone left us or someone's given us. We could all be so lucky. So then you could redo it and just have a look at what that would look like. Similar interest rate, similar term, and you would see then that your mortgage payment would drop, and they're per month, and then it would work towards, paying it all off over the same period of time. So what you need to do is just play around with it. We've not done it by fortnight. We've not done it by week. We don't find that helpful. People either get paid, well, in most cases, of course, fortnightly, weekly, or monthly. But we just want to show this as a per month thing so you can understand it, or an annual thing in those 2 tabs, plus the graph. So we'd really suggest having a look around it. And there's lots of variables here. Obviously, if we look at a standard New Zealand mortgage, let's go 700,000. It's big numbers. Let's say a 25-year term, and let's say an interest rate, and being a little bit aggressive, let's go 7.5%. Then we can see that the monthly payment for that's going to be, just over $5,000. And if we look at the monthly amortization, we can see exactly how it's going to work. So that 5,173 is fixed. But again, over time, the interest drops because you're paying off more and more principal. And then, in the last throws of the dice, which is like before the mortgage finishes, it's all being the mortgage payment. So it's all being the principal payment and the amount of interest left on that. Because you can look at the $30,000, that's what's owed. And if you're paying $5,000 per month, well, then you would expect not to be paying much interest at all, because your principal is dropping like really, really quick per month. So that's pretty much sort of revealing the inner workings of a mortgage. And I think the amortization calculator is a great way to look at it. And that's why we published it. We really want people to just make informed decisions, fully understand where every dollar goes, because we know that people just are not used to seeing these rates reset or jump up. And people are questioning, I don't understand. Is the bank making more money? How's it working? We've got guides for that as well, but we just want to show that it's just going to be a long, straight road for making these repayments, but it's certainly a proven process. So that's best revealed with an amortization calculator. Now, if you have any questions at all, please leave them in the comment section below, because we're highly responsive to them. We always reply. We want to make sure that our resources, our guides, and everything else, our calculators, are as comprehensive and as useful as possible. So that would really help us as well. Thanks very much, and best of luck with your home loan needs.